In this video, I want to talk about how we can relate trading to being a science, how we have to come up with a plan, a hypothesis, and then go out and execute what we just came up with in order to find results. And in trading, that's profits, and that's being able to successfully execute our trading plan. I'm going to relate it to a science. I'm going to talk about executing, not executing, and then I'm going to talk about getting into the right opportunity and exchanging opportunity or exchanging time for opportunity, enabling us to make profits in the long run. Before we get into it, I'm going to post a link in the description below to follow me on Instagram at Entrepreneurship. I recommend following me on here. I post daily trading recaps along with very good trading tips and tricks that I guarantee you're not going to find anywhere else. The link will be in the description below. You're seriously missing out if you're not following it. But now let's get into this re-upload about trading being a science. So you could watch the market, you could hypothesize, you could call out trades all day long. But if you're not actually executing your idea, the strategy, the plan, then what are you doing? You're definitely not trading. Same thing in the business world. You could have the greatest ideas, but if they're not executed properly, then what are they worth? It's worth nothing. A great running back could run the ball really well, but if his line doesn't block him, he's never going to be able to score. Same thing with trading. You could spend all the time in the world thinking about getting into the market, but if you're not ready to execute and manage the trade plan, then you aren't even trading. You're not even playing in this case. You're the spectator. And in trading, you have to be a player, not the spectator. Be on the field. Do not be in the stands. However, I will say it is proper to be a spectator and not be active in the market by having a trade on if you do not see your confirmation signals or if you feel like you missed the move. It's better to be a spectator and not take the trade and be okay with your analysis being correct than actively entering the market because you don't want to be a spectator. You get in late. And if you get in late, you're going to skew your risk to reward, and the trade could be a mess where you might lose a lot more compared to what your risk is, or to what your reward is. For example, I want to go over the pre-market plan. This was a few weeks ago by the time that you are watching this video. I was watching the NASDAQ. I post plans every single day in my Discord of stocks, futures, any instrument that I'm watching. I post levels of interest, setups I'm watching for, and potential trading scenarios. On the NASDAQ, this was July 29th, we are watching for a resistance at 129.45. You can see it by this mark over here. And we were watching for, usually when we test this resistance, as we did so in the overnight session or the day prior, we hit it perfectly and gap down from that. Usually when we test resistance, we pull back before attempting to break it at some point in the future. We also created demand at 12748, which is this level right here, this green box from the day prior. And I was watching for a pullback to hold into this demand zone. If true, I would expect a test to break the upper resistance at 12945. Not much supply or resistance above that level. So the whole idea with this setup was we're watching for the market to hit this demand zone. If we could hit this demand zone, more than likely we're going to go rally and test the upper resistance again, because once resistance gets tested, we usually pull back from it, and at some point in the future we test it as long as buyers are strong and willing and able to bring the market higher. So then the market opens up and we sell off right into this demand zone. Now there's some trades where it works out perfectly according to the plan, but maybe I didn't find proper confirmation that would have enabled me for entering the setup, and I have to wait it out and I have to sit on my hands and not enter the trade because my analysis worked perfectly. It sucks missing a setup even though your analysis and what you expected to happen worked out well. But essentially the market pulled back into it. We hit the demand zone and immediately started moving up. So at this point, my hypothesis, my plan worked out well. But by the time I wanted to get long, it was about this area right here. And from a risk to reward standpoint, this did make kind of sense. But I didn't expect resistance to get tested the same day with the strength of buyers. So ideally, I was looking to get long at demand. And if you go to a 1-minute chart, you would have seen a much clearer entry where we could have got long at the lows. But by the time I saw to get long, it was all the way up here. And for my analysis to be incorrect, my stop loss would have to be at the low. So at this point, I'm really risking about 80 points to make about 111, 110, 120 points. Not the best risk to reward. So because of this, I was totally okay with being a spectator, sitting on the sidelines, and not executing because I did not feel comfortable with the proper risk to reward that the market was presenting. A lot of people cannot do this. They can't accept it. And what they will do is they will get into a trade, let's just say where I marked out, or maybe they even chase it because they hesitated to entering at demand. They get long now, maybe up here. And now my risk to reward is really, really skewed, meaning my risk is really high compared to my reward. The market pulls back and maybe they stop out of this position because their target never hit at the high, right? So it's all about, if you hesitate and you don't enter when you should, it's better to miss the move than to chase it. It might work out for one trade or two trades after, but I guarantee you it's not something that's sustainable that you could repeat day after day that's going to bring you longevity in your trading. Another mistake on my end was I should have realized that this move up over here formed new demand, that the market did pull back into it perfectly and rallied. And by end of day, we hit that high resistance and the setup worked out really well. It was a missed opportunity, but I'm totally fine with it because I know my setups that work out for me, and I know I could repeat this process day after day, week after week, and come up with a hypothesis that will win more often than not. And trading execution is much larger part of success than most people think. A lot of traders are scared to pull the trigger and put risk on the table. But with no risk, there's going to be no reward. And that's with anything in life. Don't be scared to pull the trigger. Be ready to execute whenever the opportunities present themselves. So trading's very simple. Traders are the ones that make it very complicated. Every trade is either going to win or it's going to lose. It's a 50-50 shot. Every trade begins with perception or idea that the value of an instrument that you're trading, whether it be a stock, the option, a future, the idea that the value of that instrument will be trading at a different value at some point in the future. Every trade that we put on is going to form an idea that which the current price we're trading at, we're going to hypothesize that we're going to be trading at a different price in the future. So you could look at trading in this context that every trade is a hypothesis, nothing else. We don't know the outcome. We're just going to hypothesize what the outcome is going to be. Now, if you remember back from science class, every hypothesis is either going to be supported or not supported. It has distinct terms to what to expect from the plan, what's going to be done if proven wrong, what will be needed to be done if we're proven right. And in trading in this case, it all relates to our plan, and either if it's going to work out or it's not going to work. As the markets move up and down in price and value, it's going to provide extra support to a hypothesis for confirmation or disconfirmation, whether we're right or wrong. As the trade does unfold and we receive market-generated information, we're either going to be proven right or wrong from our original trade plan. So I want you all to think of a stop-loss level as an area or basically the outcome that's going to falsify our hypothesis. Now think of an exit point, a clearly defined target level, as a point or an outcome which is going to prove our hypothesis right. It's the opposite side to our stop loss. So the target, our clearly defined target area, is going to be the best possible movement if the hypothesis is right, where we're going to make the most profit, while our stop loss is going to capture the max risk that we're willing to take prior to exiting the trade if we are wrong on our original hypothesis. So a trader who lacks clearly defined targets and a stop loss level is like a scientist who lacks a clear hypothesis in the lab. If a scientist doesn't have a clear hypothesis, he's never going to know the outcomes of the experiment in the lab. Same thing with the trader. If you do not have a clear stop loss, where are you going to exit if you're wrong and where are you going to exit if you're right, you're basically going to go into the trade with unknown outcomes. Every trade should be put on with known outcomes, whether you are right or wrong. I'm going to lose this much if I'm wrong. I'm going to make this much if I'm right. So we have a hypothesis, which is going to include at what point do we think that the value is going to change. Without a hypothesis, we do not have the basis for executing our trade. So basically, look at a hypothesis as our trading plan. If we do not have a trading plan, we have zero reason to put the trade on. I will never enter a position if I do not have a plan. If you put on a trade with no reason based on intuition, you think the stock's going to go up or down, then more than likely than not, you're going to lose in that trade and you have zero business putting that trade on. I'm going to get into that in the next slide. But you're going to have good execution on a trade if you enter at a price where the amount of money that we're going to be risking if we are wrong is less than the amount of money if we are right. And that's our target versus our stop loss. So the stop loss point based on our entry has to be smaller than from where our entry is to our target. That is a risk to reward. So when we talk about a good price, and when I say, good execution, good price, I'm talking about entering with very little risk with a much higher reward. A lot of traders I see that, they enter the market and place their risk at a certain dollar amount. I have a $1,000 account. I only want to risk $200 on this trade. So they put their stop loss at a point where they're risking $200 rather than a point where it makes sense on a chart that it's going to tell you that our hypothesis is wrong. Good execution means you calibrate the risk as your reward. Terrible execution means you calculate risk based on a function of how much money you're willing to lose. So the same example with NASDAQ, you could trade the QQQ options off of this chart. They are the same. Before you enter any trade, this is vital. You must come up with a trading plan that's going to define your target, your stop loss, and where your entry signal as the market presents it. If you do not have that, you do not have a trade. I see too many people entering and exiting just because the market's moving up or just because the market's moving down. That is not a hypothesis. That is gambling. And if we're trading in the science lab, we have the risk of our experiment blowing up and destroying our account and just ruining everything. You must formulate a trading plan. It's very simple, but it goes over some people's heads, in one, out the ear, and out the other. A lot of people, if you do this and you enter without a plan, are going to do with that example I told you earlier with, okay, just because the market's up, I'm getting in right here. Oh, and we're coming down, I'm going to get out right over here, right? That's blindly gambling. You will never survive as a trader. I'll be straight up and honest as possible. However, let's just go to a 1 minute chart and let's just act like we did take this setup. The analysis worked out. It sucks I did not. But just for an example, let's say we get long when we start to see some selling pressure inside of demand and then the market starts expanding with candles expanding to the upside. We get long now at 12790. Let's just say QQQ calls at $1.20 when QQQ was at 360. My stop loss, so now that I'm in this trade right here, my stop loss will be the low. So I'm risking about 40 points right now. And my reward is going to be the previous resistance, also pre-market high. This resistance was, I think, from the high back in June of 2022. Don't quote me on that. So now I'm really risking about 40 points to make 160 points. 4-to-1 risk reward now because I didn't hesitate and I entered when I got valid confirmation and I didn't wait for the market to come up here and skew up my execution. Execution is everything in the market. So now I'm in long, my stop loss is below the low, and my target is the previous high. Then the market starts coming up, and we start consolidating. We start moving up even higher. We're up about 60 points at this point. At this point, I think we had supply from the rejection over here, from that resistance rejection. So at that point, maybe we could have scaled out some of our position at the supply zone over here. And then the market pulled back. And as a beginner trader, this would have happened to me. I would have seen this pullback and I would have started to freak out. Maybe my position was up $5,000, $10,000 at this point, and we pull back and now I'm up maybe $500 or $300, and I would have started to freak out a little bit. However, the hypothesis, even though we did pull back, did not really prove my analysis incorrect because my original stop loss was below the low. Now, there are some exceptions to this rule with market-generated information, and obviously I'm talking in hindsight at this point. There are some exceptions as long as the market presents new information and generates new structure. That's the only way I will adjust my hypothesis and adjust my stop loss or target if the market tells me to. The market's a storyteller. It must tell me everything that I need to know, and everything I need to know is right in front of me. So even though we did pull back here, my stop loss really never triggered, and I still had a reason to be in this trade because my target never triggered either, and I would have been a very happy trader if I did hold this pullback. Maybe I sold some from this little supply rejection up here. But if I stuck to my plan, and maintain that hypothesis, and I do this on a daily basis, some trades I'm going to lose on. I never win all my trades, but it's going to outweigh the losing trades if I maintain my risk to reward being higher and then maintain my hypothesis and my trading plan constantly sustainable on a daily basis. Good execution is all about patience. I call it patience because you get paid for being patient. It's all about waiting for the right setup to present itself. And then don't trade the market. Instead, trade your setups. My goal when I'm trading the market is looking for my setups. My goal is to not look at everything that's moving. It's only to look for my setups that I know is proven to work. Think about it like poker. You only want to bet when the odds are in your favor. When you bet when they're not in your favor, that's basically gambling. And when they're not in your favor, you're basically trading something. You're putting on a trade that's not in your plan, that's not in something that you tested, and it's not your edge. That's gambling. Think about it like this. When you're trading, do not take every opportunity if a stock is coming up or down. You see it ripping, don't chase it to the upside if it does not follow your plan. Only follow your setups because your setups are your plan. That gives you your edge. It's been tested to work in the past, and it's proven to work in the long run. And then the last point is you only get paid for opportunity in trading. You do not get paid for time. It's not like any other job where you work for 6 hours and get paid. You could sit in front of a computer for 6 hours, not put one trade on, and you're not going to get paid. You only get paid for opportunity. I see I just spelled that wrong. There's supposed to be an O in there. You only get paid for opportunity, not time. So that's your goal, to be patient, to wait long enough for the highest probability setups to present themselves. So I hope this video helped. If it did, drop a thumbs up on the video. I'd really appreciate it. Comment if you have any questions, and definitely check out the links in the description below. I offer a very in-depth and educational course. It comes with access to the Discord at no extra charge. I will be making some changes, hopefully by the end of this month. Peace out.